Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Thursday, April 2nd, 2026. We're recording at 3:30 Eastern Daylight Time. I am your host, Scott T. Slayton, partner and chief strategist at Capital Creek, and here is your starting lineup. Number 1, the hidden costs of the Iran war. My friend Joe Kalish enlightened me on some of these hidden costs. Interesting to share these with you. Number 2, the ISM Manufacturing data for March. The manufacturing recovery continues, albeit with higher prices paid. And number 3, what happens if the U.S. just walks away? A tactical victory, but a strategic loss? So back to number 1, what are the hidden costs of this war? Well, we know that abundant Middle Eastern capital flows are slowing due to the war. The Middle East has been a bonanza of capital for the United States and Western democracies and their economies for decades. But the hope of Saudi Arabia committing $1 trillion to U.S. infrastructure is fading. And the same is true for some of the investments that were promised to be made by other GCC countries. When war occurs, money comes home and is husbanded. It is less inclined to go out to the rest of the world. And we believe that's what's happening in the Middle East. Energy infrastructure is going to need to be rebuilt. Security is going to need to be enhanced by a lot. And military budgets are going to rise dramatically. Those are all uses of capital from Gulf countries. Defense spending, most of it will probably flow to the United States, but that is a dead weight for GCC economies. Doesn't really help their economies much. And the hope of building data centers near cheap Middle Eastern energy is, in some ways, literally going up in smoke. It's hard to see how that's a viable alternative in the near term. So AI buildouts may begin to slow as a result of less Middle Eastern capital flowing to the United States. They've helped finance a lot of this buildout. And the other side of this is there's just less demand for U.S. securities. You can see this in the data for March. And last week's 2-year auction, which had a big tail and was very weak, I think is indicative of less demand for U.S. securities. So in sum, the hidden cost of the war is reduced foreign investment in the United States. That's a big change from 1 month ago. Now, number 2, the March ISM Manufacturing data. So the March headline ISM printed 52.7 versus 52.3 estimates and 52.4 prior. For the 3rd consecutive month, the U.S. manufacturing sector grew, and the ISM was well above 50. This is the first time in over 3 years. So manufacturing has been in contraction all of 23, all of 24, all of 25, based on the ISM. But the upside surprise was mostly a consequence of the Iran war. We've got slower supplier deliveries, depleted inventories, and accelerating prices, and weaker employment. That's not really a great picture. So while the headline number is up, it is mostly for war-related reasons, not traditional economic expansion reasons. And the one fly we saw in this piece of data was that the prices paid component of the survey hit the highest level since June of 22. Think back to June of 2022. Headline inflation was almost 10%. That is an ugly data point, and it points to acceleration in inflation even within a month of this war starting. So that to me is a concern. But on the positive side, we're also seeing no evidence that U.S. business or consumers are cracking. That's very good news. And that was supported by stronger than expected auto sales during March. In fact, those sales were the best since September of 2025 and printed over 16 million units, which is very solid. So unlike Gulf War I in 1990, when the consumer just fell out of bed, that is not happening this time. And I think it's because businesses and consumers have learned how to live with constant uncertainty over the last 18 months. This is called adaptation. And I think consumers and investors and business people are adapting to a world of constant uncertainty. Now, number 3, what happens if the U.S. just simply walks away? Well, in a speech last night, the president said that the U.S. military campaign would wrap up in 2 to 3 weeks, plus maybe a few days. So it was very specific. The bombs should stop dropping in 3 weeks, if we're going to take him literally on that. But I think maybe more importantly, he hinted that opening Hormuz may not be a military objective for the United States anymore. And I think my analysis leads me to believe that Iran is unlikely to reopen Hormuz just because the bombs stop falling. The U.S., in my opinion, is also unlikely to completely destroy Iran's energy infrastructure because the world needs that energy to flow. Otherwise, we will have higher prices, and Iran as a nation could become a failed state, which would be a catastrophe for Europe and the Middle East. Come to my attention in my digging on the subject that hardliners in the Iranian Revolutionary Guard Corps are now firmly in charge. The supreme leader, if he is even still alive, has been subordinated to the IRGC. He owes his status to the IRGC, and thus he is subordinated. For the first time in almost 50 years, a supreme leader is not really the person that's in charge here. And these hardliners prefer a hot war to a cold peace. If they're going to suffer and not have the money to rebuild, they might as well cause suffering on the other side. And that's what I've heard, is that they're not going to let us just walk away. They're going to try and keep Hormuz closed. And keeping Hormuz closed is their best weapon to get the U.S. and Israel to go away, to cause us real pain economically, politically, and to get us to stop and go away and never come back. That's what they really want. So my opinion of this situation as it stands today is that the negative feedback loop continues. Hormuz remains closed. Oil prices continue to ratchet higher. Yields continue to ratchet higher. The dollar is stronger. Equities move lower, and the U.S. economy continues to slow at the margin. So we are sellers of rallies in stocks and buyers of dips in oil. We reiterate our tactical target on the S&P 500 of 6,000 over the coming weeks. So do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.